In this lecture, we're going to explore just a couple examples of how interest rate decisions can have a major impact on the Forex market. Our first example is the New Zealand dollar, US dollar, this year 2014 on July 23rd. So a little bit of backstory. The Royal Bank of New Zealand had been expected to raise the interest rate on this day from 3.25% to 3.5%. And they did. They raised the interest rate. And like we talked about, generally raising an interest rate is a positive sign for the value of a country's currency. But in this case, the value of the New Zealand dollar fell dramatically against the US dollar immediately after the interest rate decision. Now, why would that be? Well, New Zealand had been expected to continue raising interest rates through the rest of 2014. But at the time they made this decision, the governor of the Royal Bank of New Zealand said that they were not planning on increasing interest rates over the next several months. They were going to keep it at 3.5%. So remember how we talked about that interest rate outlook and what currency traders expect an interest rate to do can actually be more important than the actual interest rate itself. Because he changed the outlook for the New Zealand dollar, that's why we see this massive downtrend, this massive fall in value right at the time that he made the decision to keep the interest rate at 3.5% and not continue to raise it. Our next example is also an interesting one. This is the Turkish lira. And what happened here back at the beginning of the year, we can actually see on the chart, the lira had just been absolutely taking a beating against most of its major trading pairs. This is well over 2,000 pips here. And the reason for this was during the financial crisis in 2008, emerging market countries like Turkey, Brazil, Russia, and India really had the benefit of having a lot of investment in their economies because there just simply wasn't much appetite for risk or for investment in more developed countries that were experiencing this global financial meltdown. So what these countries did is they lowered the interest rates on their currency because money was coming into their economy. They didn't need the high interest rate to attract that investment. Turkey actually lowered their interest rate from about 11% all the way down to 4%, which is pretty low for an emerging market country. And as the global recession started to fade away and we saw more strength, especially in the United States, the Central Bank of Turkey kept that interest rate the same. And because of that, investors left Turkey and went to more developed Western economies. The appetite for risk was back on. So this massive rally against the lira occurred. So the Central Bank of Turkey, realizing that this could have some pretty major implications on their economy, suddenly raised the interest rate on the lira from 4 to 10% with no previous warning. And that actually caused a major stabilization in the value of the lira's interest rate, or of the lira's exchange rate. But you can see here, right after the exchange rate decision, the market behaved very, very powerfully, returning value to the lira. We actually saw a gap in the market, which means that the market closed for the weekend. And when it opened back up on Sunday night, there was a big gap in prices. Nobody would be offering lira at the price it was available for here, just because that interest rate decision was so shocking to the market. So you can see that two examples here are just a few of many examples where interest rate decisions really can have a major impact on the currency market.